All right, so we have a few things to talk about on your list, and let's start with the whole situation with interest rates, capital adequacy requirements, and how it's related to dividend payments. What's going on there? Give us the update, bring us up to speed.
Okay, yes. Now, these are some topics we may have discussed over time, looking at different companies, different events. But I think right now we're seeing more things tying into the whole issue of companies and dividend payment. And we know that there was one that was quite a bit topical recently, one of the largest companies in Jamaica, in the Caribbean, in the region, and really expanding rapidly. I would say rapidly, that's my term, right? But a lot has happened over the last several years. We know COVID, we've spoken about that extensively and how it impacted the broader economy, global economy. Then, of course, there's this conflict that has impacted commodity prices, and prices have gone up. Financial companies in the US, that's what they trade, right? As a result of the inflationary, some monetary policies globally, there's an expansion in money supply. There's a process. We can look at that at a later date. But interest rate, in order to contain inflation as a result of that expansion in monetary supply, the monetary authorities globally in different countries, including Jamaica, have sought to increase interest rate, right? And there's a process. We can look at that another time. But this has impacted financial companies in particular. Let me just quickly look at why. Interest rate goes up. Now, there's an inverse relationship between bonds and interest rate, and it makes sense. If you lend money at, let's say, 10%, right? So you lend $1,000 at 10%, you're getting what? That's $100 per period, let's say per year, right?
Right.
And then someone else comes in to borrow money. Generally, interest rate is going up. Interest rate in the average economy is 12%. It means that 10% is generating less than what you can get on a 12% instrument, right? So the price of that bond will go down. The 10% bond will go down. So that's the inverse relationship between interest rate and bonds. As interest rate goes up, trends up in the economy, then bond prices will go down. That's the inverse relationship. Now, what assets do financial companies hold mostly? They hold financial assets, right? Not that they want to lock up their money into land, building, and all these type of assets. Banks are in the process of unlending money to make more money, right? And they facilitate the economic growth. So they don't lock up money in physical assets. They don't have factories, right? What they buy is financial instruments. What are these financial instruments? Banks take your money, they lend it out. They might structure a note and lend it to a particular company. These very complex arrangements over a period of time, and that gives rise to different types of financial assets or instruments, right? So imagine when a bank like NCBS, large bank, has trillions, perhaps trillions of dollars worth of assets, because they take all the hundreds of billions of deposits, they lend it out, they make money, they lend it out, they make money. So they're holding all these assets in their balance sheet, and interest rate trends up on average. The asset in their balance sheet goes down, the value. So you can see how it impacts the balance sheet. If your asset fall, your ability to generate further revenue is hampered also, or impacted negatively. Assets, right? Let's look at a real financial institution, real meaning a company that has real tangible assets and produce real tangible goods. Your assets, your land, building, your tools, your raw materials, all of these are the value of your assets. The more you have is the more you can produce. Therefore, the potentially more revenue you can make. That's assets for a tangible, real company. For a financial company, assets, bonds, financial instruments, the more assets they have, the more potential revenue they can make. So you can see how a high interest rate has impacted financial companies, right? Particularly investment houses and banks, right? And the ability to generate revenue. That's one thing. Now, the global economy has been growing over the last several years, and there perhaps is a potential for increased conflict. So banks have to seek, and some banks, especially in the US, they have been taking risk or coming out of the financial crisis, right? So monetary authorities, in the Jamaica's case, BOJ, in the US, the Federal Reserve, they now have to find ways of ensuring that the massive collapse we had, then we don't have it again, especially with coming off COVID and then this international conflict and then the increased interest rate. So they now put into place various rules, regulation, and directives to guide financial institutions to ensure that they don't take undue risk that can jeopardize and throw an economy out of chaos. It has happened in 2008. Remember, the good thing is that Jamaica had strong regulatory practices beforehand, that we didn't buy these complex, very difficult financial instruments that was being traded globally in 2008, 2009. However, we are a small economy. So we have the regulatory. Now, there's an international convention, this called the Basel III or the Basel Committee, right?
Right. David's been telling us about that for quite some time now.
Exactly. And what they have done is international corporations as well as governments and different jurisdictions have come together post 2008 and said, how do we secure financial entities? It's very complex. Even if you look at international shipping, we talk about financial companies, international shipping. When you're going to send a ship abroad, transporting hundreds of millions, maybe billions of dollars worth of goods on the high seas, potentially in a dangerous area where there's potential for war. I mean, look at the Russia-Ukraine conflict and this issue of grain, right? You have to insure that ship, insurance companies. So they know as a financial company that is impacted by events, right? So you can see the complexity of the financial arrangements globally, right? Involving banks, especially in the case of NCB, a bank that has a significant asset called Guardian Holding, right? That is impacted from different areas by everything that is happening globally. It has an impact, it threatens the company, right? The resilience of these companies is guaranteed through good management, prudence in how the companies are managed, yes, as well as through the regulatory authorities. So the point I'm raising, though, is that there is, of course, a high interest rate environment. We spoke about that and the impact on balance sheet assets, the financial company and balance sheet and the ability to generate further revenue. We spoke about the Basel, III committee and how they set regulatory practices, particularly what we call capital reserves, right? Capital adequacy ratio, CAR, that's the term we use, and there are various others, where they said what they call the risk-weighted assets, right? You must retain, when NCB takes your money, or any other bank, JMMB, structure some instrument, and you come and you buy it, right? There are guidelines as to how much they can off-lend to other entities and the risk associated with those lending, right? So based on the different risk structures that financial entities undertake by off-lending money or engaging in other products, based on the risk structures of these, they must retain a certain amount of money in cash or near cash, that in case people want money for some reason, they can get it, that there's no run on the bank. You notice that there are run on banks when people believe that a bank cannot pay them, right? When people and companies believe that they can't transact their everyday business, for example, the real productive company, the service companies, you and I who need cash every day, we go to the machine, if we need cash, so liquidity is important. So a bank must retain some amount of their capital in cash or near liquid form, meaning some instruments that are a 1 month instrument, a company borrow money just for a month or 3 months, these are short-term instruments, right? And they must retain that so they can have access to cash to satisfy liquidity requirements over any period of time. So Basel III set a global standard, and of course, individual companies can add to that, right? To ensure that their financial system is not.
So draw the line for us now, Clive. So Clive, draw the line for us now. How does that, banks being required to have more cash on hand, be more liquid, how does that affect the whole situation with interest rates?
Okay. Well, what it means, if you take $1 billion in deposit, but you can only lend, let's say BOJ has a reserve requirement. I think might have been 10%. I'm not sure. Don't hold me on that. Right? So that amount is kept with BOJ. No interest is paid on that. You can lend 90. If you have other requirements and based on a risk structure, you have to retain a certain amount of cash. It means that perhaps you are lending 70% of that, but you are paying interest on 100%. So you are lending 700 million to make money on 700 million, then that's what I should say, but you are paying interest on $1 billion, right? And you have different type of instruments over different time period tenors, right? That pay different, has different interest rate structures, right? So that now impact how much the business banks can do, and therefore how much revenue they can generate, right? So that will impact, what should I say now? That can impact, its ability to generate revenue. So that is based on the regulatory requirement. But the next impact is high interest rate. If the bank borrowed $100 billion, off lend, let's say 700-800 million, so they have assets of probably 700-800 million, and then interest rate goes up, the value of that asset has fallen. So they don't no longer have value of $700 million holding in their balance sheet as assets. You know, that is money that is due to them over some period of time that they are generating revenue on. They have lower value. That again impacts their potential, not just their balance sheet now, and their reserve requirement, including capital adequacy requirements, but it also impacts their ability to generate further revenue. So it has a cascading effect, we can say, you know, on the financial institution's ability to generate revenue. So we have high interest rate environment, we have Basel requirement and other regulatory requirement, and then we have international accounting standard that again is trying to safeguard the financial system as well as individuals' wealth, right? For example, IFRS 17, which is an accounting standard, is not a regulatory pronouncement that is steeped into law, right? But it is a requirement that is globally accepted, and it's almost as good as a law, really, because it is expected that you structure your financial statements accordingly. But what that does now is adjust financial, particularly insurance. IFRS 17 affects mostly insurance companies. When an insurance company makes, I'm just speaking in layman terms and generally, when an insurance company collects premium, it generally records that as revenue. So when you look at the financial statement, it's a revenues, right? It has its cost, and then it invests some of this over a period of time and generates some amount of additional revenue. IFRS 17 is saying you cannot recognize, based on your risk profile, based on the type of insurance contracts written, you simply cannot recognize all of that as revenue. You have to apportion it over a period of time based on the length of these contracts. So if a company used to collect $1 billion of premium in a particular period of time, let's say over a 12-month period, and record that as revenue, that company may now have to record less as revenue. That will affect all the performance metrics. That is, in terms of, you might say, earnings per share, which is a popular metric, right? It will filter down to book value, that is the value of the shares itself, how it is measured through the balance sheet, that is assets minus liabilities, right? It can impact various valuation metrics. So it means then that, and therefore, well, first, valuation metric. So the price, how you measure the value of a stock will be adjusted also over any period of time, over a particular period of time. Over the infinite long run, we can say the value of the stock will remain the same, because you're looking at over an extended period of time, right? But certainly within a period, short term to medium term, that is in excess of a year, 2, 5, or 10 years, you may have to adjust the value of that stock. It means then if I were looking to buy a stock in order to perhaps sell it over a 5 or 10 year period, I will have to adjust the value, the expected value on that stock over that 5 to 10 year period. And more than likely, it will be lower. That is all things remaining the same. So that's how interest rate, how it impacts balance sheet. Regulatory requirements, for example, reserve requirements, right? And of course, Basel that speaks to risk-weighted reserves, right? As well as IFRS 17, which now has stipulates how certain type of revenues are recorded, measured first, right? All of those will impact how a company reports its financials, right? So the type of revenue we used to see, the type of profit we used to see, it may be adjusted somewhat downward. And I said downward, all things remaining equal. That is, let's say they are doing the same amount of business, right? Writing the same types of contracts. Of course, businesses are creative As the economy grows, the circumstances and needs changes. So more than likely, and as the global economy grows, and of course, Jamaica's economy is growing. We see that, right? We're expecting these very same entities to do well, even increase business over time. So I'm not saying that revenue will fall. I'm just saying all things being equal, we are constant. We expect some adjustments, and that could impact, at least in the short term, the valuation on these companies. Right? Now,
Interesting.
yes. Now, as a result of companies, in particular financial companies, generating lesser revenue and lesser profit, as a result of their balance sheet, their valuation being impacted, especially let's speak to the high interest rate environment, it means that a company's ability to generate cash or to generate profit in order to pay dividends might be impacted. As a matter of fact, it is impacted because we have seen that several financial companies in particular have either discontinued finitely in the interim dividend payment, have adjusted dividend payments downward, and some new companies just recently have announced, for example, Access Financial, their last announcement, they have declared a dividend. Their prior announcement, they did not declare a dividend. Jamaica Stock Exchange just recently met and did not declare and chose not to declare a dividend. Right? So we can see how that has impacted the market space, not just post-COVID, global commodity prices, which increase risks, but also the high interest rate environment, implementation of Basel IV, which has increased that rate, and of course IFRS 17, which has instructed some adjustment to how revenue, particularly insurance companies. And what is of interest to note is that even though IFRS 17 speaks specifically to insurance companies, it is not restricted to insurance companies, because products that has that type of life in casualty product attached to it, for example, a mortgage, may be or could be impacted to a lesser degree, yes, but could be impacted. So any financial institution that offers mortgages that has that type of casualty insurance attached to that mortgage, or even some regular products, you might say higher purchase companies, say credit cards has this type of casualty product attached to it. In case there's something happened to you, they have an insurance portion to your credit card that will pay off the outstanding balance. Higher purchase companies, any product that is sold by any company that has this part attached to it will be impacted by, may be impacted by IFRS 17. And it is really to protect the markets, because financial markets are the entire economy is very heavily dependent on the proper functioning of the financial markets. Just think about it, what money is. It's not just about money in the hard sense of it being able to buy goods and services, right? That's how individually we see it. But it's a very complex system that facilitates trade, facilitates production, facilitates exchange. If I want to cut your lawn and you want to pay me, it's a financial transaction, right? And somehow, in some way, the financial institutions impact that transaction, that arrangement, a simple arrangement. So it's really a very complex but very sensitive system that has to be protected and monitored at all times. And this is why, even in Jamaica, we may see an increased watch, and well, we have seen it really, right, on everything financial, everything within the financial sector, individuals, companies, how they operate, the persons who run companies. There's the fit and proper offered by FSC, which has a profile of individuals who are employed to financial companies that must be completed, and it's called a fit and proper. So it must be considered fit and proper to be employed and to engage in certain positions or job function within any financial entity. But
so
it's a very tenuous situation.
We have quite a few questions from our viewers. So let's take some of these questions. Yes. Orville wants to know, with all of these high interest rate environments that we're in, who benefits? Because some, if not all, banks' interest income is affected.
Right. That's a good question. No one benefits. I can't say anyone benefits. because it slows down the economy. We can see easily how it slows down the economy, right? 5% versus 9%, 10% versus 15%, right? Who benefits? No one benefits. But maybe in the long run, everyone benefits. In the long run, in the short term, certainly. It is designed to protect the economy. For example, it is designed, at least based on classical economic theory, to slow down the economy in the sense that temporarily slow down the economy so the economy can grow at an acceptable pace later on. What do I mean by slow down the economy? It's a complex process, but let me see if I can simplify it for you. When there's a lot of cash in the economy, when business is doing good and they are making tremendous amount of profit and there's a lot of business activity, people are making income, people have more money to spend, people begin to compete. And if production cannot keep a pace of the wealth of people growing, people are going to compete to buy goods and services, meaning people are not demanding more luxurious cars from dealers, not from one time, that's the second-hand market, what do you call it, deportees. And people are now buying brand new cars out of the factory, right? Luxury vehicles are no more available in Jamaica. These cause a pressure on the Jamaican dollar. These are heavy demand for cars, pollution, parts, gas, that is energy. So all of these things causes inflation. In order to slow down inflation, that is to put a curb on some of these activities that is driving inflation, the regulator authority increase interest rate, right, to slow it down. So the idea, it's seen negative in the short term, but it is really designed to slow down the economy sufficiently that all the different parts come in sync, and then now we can have, should I call it, a controlled, acceptable growth going forward. So in the short term, perhaps I could say no one benefits, but it is designed that, or it is such that in the long term, everyone benefits.
Next question comes from Nicola, and it's on a different topic. So Nicola has been observing what's going on in the United States. Their credit ratings were recently downgraded. So she says, hello, with the downgrade of America credit rating from AAA to AA rating, how is this going to affect the Jamaica stock market? The debt ceiling in America is going up. Do you have any insights on that, Clive?
Well, yes, I could speak broadly on it. Yes. Well, just like Jamaica, what we have experienced over the last 40 years or so, we were borrowing. And when you borrow, what happens? You now have an accumulated debt. Your debt burden gets heavier and heavier. And if your economy cannot keep a pace in terms of production to generate enough revenue, and remember, it's the government that pays on these debt. So if the government can't collect taxes, which is dependent on production, efficient production, then we're going to have an accumulated debt burden. The fact is that the US, being a global economy, resilient economy, a very creative economy, can more handle a higher and higher debt ceiling or government borrowing. But a big part of the US is that there's a level of liberalism in the financial system and sector, and financial institutions are at times, at least pre-2008, were at liberty to create complex financial instruments. As in, we talk about these asset-backed, some of them are asset-backed mortgage structures of 2008, right? That eventually cause a collapse of the financial system or a collapse of many of these entities. In the US recently, we saw the collapse of 2 or 3 banks, financial institutions, and the feds had to come in and shore them up. This is what has caused Fitch in particular. Fitch, I believe, is headquartered or domiciled in Britain, I believe, right? Not Moody's and not Standard & Poor, right? I'm not sure where Moody's domiciled, right? Standard & Poor, certainly US. And they downgraded the US government just like they would have downgraded the instruments and the debt instruments issued by the government of Jamaica or coming out of Jamaica.
Right. So let me just interject here, Clive. So viewers, you may be familiar with this whole issue of downgrades and credit ratings for countries because of what Jamaica has been through, especially when we went through the whole cycles with the IMF. And every time you hear news about Jamaica get downgraded, and then more recent years, it was all about upgrades, which is awesome because we have three major international credit ratings agencies, and Clive just referenced them. We have Standard and Poor's, we have Moody's, and we have Fitch. So the highest credit rating that you can have is AAA. Then from AAA, you go to AA, then A. And then even within the bands, you have positive and negative, like you get A plus, A minus, and so on. And then you go into the B range. Jamaica is, I think, somewhere in the B range now, which is pretty good from where we used to be. We used to be like in junk bond status. So America moving from AAA to AA plus, they're still at investment grade, but it affects their ability to borrow. Does it?
Yeah, exactly.
Even?
Yeah, it does. It does. It does. It does. It does.
Pretty good.
It does. It's risk. It's called risk. And what it means that they may have to pay more to borrow. And as they increase the debt ceiling, they have to pay but borrow more nominally and pay. Overseas lenders will demand a higher interest rate, and that will put more fiscal pressure on the country. And that again can have a cascading or replicative effect in the broader economy. So it's a very fairly complex, but on the base level, fairly you can see how it impacts all levels of the economy. And I think that is what the US go. But maybe there's a level of arrogance because the same thing happens to other economies. So it can happen. It should. Their ability though to bounce back is different because they have maybe, I don't know, but sooner or later though we may see more as credit agencies get comfortable or get more unbiased in their ratings. We may see first world countries being downgraded a little bit more. And remember, the international global landscape is changing. You see, we know about colonialism. We know the control that the quote unquote West and the Western financial institution has over the global economy, global trade. It's powerful. Really look at that, right? Shipping, you name it. As a matter of fact, this impasse, I would say, our issue with Russia and the West has really highlighted for persons who did not know the power of the West and the level of control they have over every institution, global institution, including sports that I thought was excluded from political harangues, right? Sports. But international shipping, in fact, many of the global insurance companies are Western domiciled, Western based, Western owned. And many of them have stopped insuring Russian ships or ships that carry Russian goods. That's the power and the impact. So the point I'm raising though is that as a result of that, we heard about BRICS. We heard about China's Belt and Road. We know that China has established this development bank that several companies, including at one point, the German government had signed on to. We know Belt and Road, which is a trading route initiative initiated by China. Italy had signed on to it, but Meloni, the new president, is a little bit hesitant. Now they start that they might withdraw. But the point I'm raising is that the international global environment is shifting and changing out of favor of the US and the West. So it means that we may see additional international rating agencies outside of the Western ones, which are Standard and Poor's, Moody's, and Fitch. And we may see even these entities having the courage to know, I would say, my term, unbiasedly rate these first world countries. And it's not the first time that the US was downgraded. I'm not sure which one. It might have been Moody a few years ago. I think it was during Obama's time when there was a crisis between the Republican within the House of Congress, budgetary impasse, and they couldn't come to an agreement. I think so. It might have been Moody during Obama's tenure. So it's interesting.
This is very interesting, guys. Jamaica and countries like us aren't the only countries that get downgraded. But according to Clive, there's been some bias in the international credit ratings agencies, and now we're starting to see where they're getting braver and bolder to give, their true opinions of what countries like the United States are doing. So part of the reason for the downgrade, probably the reason for the downgrade, America borrowed an extra $1 trillion. Trillion. How much zero that? 12 zeros?
And it's not
Trillion
Jamaican.
pounds, that's an extra trillion US dollars.
Yes.
So,
Yes.
so yeah, they have a debt issue. Debt
Yes.
problem,
Exactly.
issue meaning problem, debt problem.
Yes.
So yeah, a lot going on in the United States. And so
Right.
think of it on a personal level, think of it as the US losing points on their credit score.
Right.
If that's a good way for you to think of it in terms of comparison. So we have another question, Clive. By the way, viewers, I am stretching with Clive, so this segment is going over time because we're still waiting on Kadeen. I got the last update we got from him was about 10 minutes ago. He was going through customs. So I know that he's really trying his best to be with us this evening, and we're going to give him as much time as he needs because, it wasn't his fault. The flight was delayed. We did try to book a different show at the last minute this evening. It didn't work out. So this is what we're going with for this evening. He does want to do the interview, and he's trying his best to clear as quickly as possible. So we have a question here from Shelly-Ann, and she wants to know about Fosrich. So Shelly-Ann says, question for the analysts. What do they think about Fosrich rights issues still being above stock price since the announcement the price is just falling more?
Yes. Okay. Well, I didn't do any. Let me see if I can pull up some metric on Fosrich here. But here's the thing with Fosrich. Fosrich has done well. I mean, there are quite a few of the listed companies have really rewarded shareholders, right? And not just in terms of price. I mean, price must reflect growth, real growth in the company, and the company has grown, creatively managed, and they do have prospect for growth. But the company, we want to separate the company from the stock, right? The company is the entity that employs people, engages production, doing its thing, to generate revenue and profit, etc. But the stock is what you and I buy. Let me see. The stock is what you and I buy. Sometimes, when you look at the fundamentals of the company, that is when you look at the actual financial results that are written in that document, and you look at the numbers, and you use those numbers, either the cash flow statement, maybe the P&L and the balance sheet to value the company, you may find out that it is trading at a value. The stock is trading at a value higher than what the company is valued. So we're separating the two. The company, the real entity that produces and generates revenue, and the stock, what we trade and how we value the stock, right? And many times that is what is happening. Let me see if I can find the metric. I should have them right here. But I believe though that the Fosrich rights issue, that I would believe that they had negotiated with several buyers beforehand, and they had their buyers before, and they had agreed at a particular price. More than likely, they would have done that, you see? And then, but the market though is post-stock split, right? The market has a tendency to drive prices up after a stock split, yeah? And we need to think about that, right? So I believe that it was already overpriced, right? Let me see if I can find the valuation here, but it is overpriced. Let me see. Fosrich. I have a bag of information here, and my eyesight not so good. So, okay, here it is. Right. Okay, good. Fosrich. It is trading at a price to earnings ratio. These figures were calculated using Friday gone. Last week, every week, Friday's prices. It is trading at a PE ratio of 37.9 times. What does that mean? P over E. The price over the earnings per share. We can buy a stock unit, for example, for Fosrich. We can, as at last Friday, we pay $2.17 for that one stock unit. And you can say, okay, Fosrich is trading at $2.17. For argument's sake, comparison, I'm just using a number here, right? Future Energy Fesco is trading. You can buy a Fosrich stock at $2.17 Jamaican dollars. You can buy Fesco at $3.94 Jamaican dollars. Or you could say you could buy Cargo Handlers at $19 Jamaican, right? You could say that. That's what you pay for one stock unit. However, We want to take it one step deeper. Rather than say $2.17 for a stock unit versus, in the case of cargo handlers, $19 per stock unit, what you want to do is measure this value, the $2.17, not against a stock unit, the $19, not against a stock unit, but the $2.17 against the profit it earned. Can we pay $2.17 per stock? So you ask yourself, what is the profitability of that stock? What profit did it generate? Same thing with cargo handlers. What profit did it generate? So if you look at the earnings per share of Fastrich, it has an earnings per share of close price at 12 months. Okay, I don't have the earnings per share here. But here's the point. $2.17 divided by what number? To get 37, roughly almost a PE of 30. Of 2.17 divided by 37, 37.19, 37.9. So it has an earnings per share probably about 5 cents. Call it nearly 6 cents, right? So $2.17 divided by 6 cents, what do you get? 37.9. In other words, what it is saying, that you're paying $2.17 for a profit of 6 cents. Cargo handlers, you're at $19, you're paying, and its PE is 25.97. Call that 26. Round it up to 26. Cargo handlers, you're paying $19 for a profit of 73 cents. So $19 the price divided by the earnings per share, the profit per share is 25 or 26 times. So a PE, price over the earnings per share, is 25 times, as opposed to Fastrich, right? $2.17, even though the price is nominally cheaper, the fact is that the profit on that stock is so much lower, right? So the higher the PE, all else being equal, the higher the PE is the more you're paying. The price to earnings means that you're paying 37 times the earnings per share. That's what it means. So usually when a stock is trading at 10 times, a PE of 10 times, it means that you're paying 10 times the profit. Whatever the stock price, if the stock price is $10, the earnings per share is $1. The profit on that same stock is $1. So you're paying a PE of 10. If the price
and for our newbies, Clive, is that good or bad?
Okay. The higher the PE means that you're paying relatively more for the stock. And a PE of 9 on Fastrich of almost 38 times means that you're paying 38 times the profit for that stock price. As opposed to, when you look at the weighted average for that industry, and cargo handlers, the PE is 25 times, call it 26 times, you're paying 26 times the profit on cargo handlers at a PE of 26 times. If you look at future energy, you're paying a PE of 17.4, means that you're paying 17.4 times the profit on that same stock unit. So the lower the PE is, the better the price.
Well,
the point I'm raising is that
Clive.
Yeah.
So I hope that answers your question. I think it was Shelly Ann who was asking the question. We actually have Kadeen backstage now, and I know that he's been through a lot today. Hopefully his internet holds up, just like mine. Where I am, my internet is kind of not the best either. So let's wrap it up with you, Clive. Thank you so much for joining us, and we're gonna wrap up the analyst segment and go to Kadeen Mears in just a moment.